Okay, well, thank you for joining us for our first investment outlook webinar of 2026. I'm Jan Vega, a wealth manager in our Los Angeles office, and I'm joined by my colleague Laura Boucher from our Milwaukee office. We're also joined by John Allen, our Chief Investment Officer, and Marc Castellani, Managing Director of our Investment Strategy and Research team. To set the stage, I wanted to briefly reference our recent quick takes publication that we sent out last week titled Geopolitical Tensions and New Economic Data. It captures what many of our investors are feeling right now, which is despite the headlines, markets have held up better than anticipated. Even with the recent geopolitical developments, markets have remained relatively steady. Stocks have moved higher, returns are driven by a wider range of investments, and investors have continued to focus on diversification rather than reacting to short-term news. At the same time, the economic picture is evolving. The labor market continues to cool with the low hire, low fire dynamic, and growth is easing rather than stalling. Policymakers have also responded, with the Federal Reserve cutting interest rates by about 0.75% since September, and additional support coming this year through roughly $200 billion in tax relief. So today's discussion is about how we're guiding portfolios through this environment by staying focused on long-term goals, managing risk thoughtfully, and finding opportunities even as these headlines continue to change. To make the most of our time together today, we encourage you to share what's top of your mind. You can submit your questions using the dialog box on your screen at any point in time during our discussion. The presentation slides, along with the quick takes article that I referenced earlier, are also available on your screen, and a recording of today's session will also be shared with you shortly after our call. And with that, I'll hand it over to John to get us started.
Thanks, Jan. Hello, everyone. Okay, so given all of the recent developments, we thought that it was important to continue our discussion on powerful global forces shaping the world order. Each of these 5 forces at the top of slide 4 will serve as our agenda for our prepared remarks. Importantly, please note that each of them can occur both within and across countries. Today, some of the most important aspects of economic growth relate to the generation and distribution of income and wealth. And as Professor Peter Atwater recently being credited for popularizing the term K-shaped economy. And that term is used to describe uneven and widening differences across stakeholders in an economy. You've probably seen headlines in Bloomberg or the Wall Street Journal on K-shaped economies. Technology advances are at the center of the changes we've been experiencing and therefore at the core of today's conversation. So throughout the discussion, we'll touch on the impact of artificial intelligence and robotics and what they could have in terms of jobs, payrolls, taxes, deficits, and debts. Energy availability is vital to any country's competitiveness, especially given AI's critical role going forward. And Marc's going to touch on that as well. And then there are political tensions, both within and across countries. The U.S. finds itself faced with deciding how we'll increase our federal revenue and how we'll distribute our federal outlays. This will be especially challenging if our federal budget is constrained by AI. So how we choose to deal with that issue may determine whether or not the United States experiences political and societal upheaval in the transition years ahead. And when we refer to transition years, we're really talking about the transformation of the economy to a more digital, automated AI world. Last quarter, we talked a bit about a resource grab that was going on around the planet. We'll touch on more of that topic today, but we'll highlight it with our comments on Venezuela and Greenland. Now, we understand that all of these shifting issues and the shifting world order can feel unsettling. But the U.S. remains the strongest country, and our foreign policy decisions could either strengthen or weaken our standing. A key challenge that we see in the years ahead will be how we come together as a country to compete against other countries, and specifically China. China. Okay, so on the next couple of slides, we'll talk about some K-shapes, or even the uneven and widening economic divergences we see across data sets. The top chart on slide 5 compares equity returns versus consumer sentiment. Using the S&P as a proxy, we can see that the overall wealth of asset owners, specifically those owning stocks and mutual funds, had risen over time, and it didn't really matter whether a Republican in red or a Democrat in blue was president. Conversely, consumer sentiment in the gray line has plummeted, and that's especially true since COVID in 2020. That separation in those two lines creates our first K of the day, which is indicated by the dashed black arrows. Now, importantly, ownership of stocks and mutual funds is highly concentrated by wealth, with the top 10% of us owning approximately 90% of public equities. The next 40% own approximately 10%, and the bottom 50% own around 1%. So as the line for the S&P 500 was advancing, the wealthiest among us were enjoying most of the benefits. However, the poverty rate in the US is also near a multi-decade low of about 10.5%. So everyone has enjoyed a better standard of living. This is really about the fact that there's nothing worse than losing to your neighbors. So even if you're doing somewhat better, seeing other Americans doing much better can feel disturbing to some. Okay, so with any K-shaped chart, there tends to be a deeper story below the surface of the headline data. So for example, in the bottom chart, we separate the headline consumer sentiment that was talked about in the top chart, again, that was the gray line, into the red line and the blue line based on one's political affiliation with the Republican Party or the Democratic Party. Naturally, one's political perspective influences sentiment. So when a Republican was president, Republicans felt good about the economy. And you can see that with the red line being the highest during the Bush, Trump 45, and Trump 47 presidencies. Likewise, when a Democrat was president, Democrats felt good about the economy. And you can see that with the blue line being the highest during the Obama and Biden presidencies. Notably, each group of consumers felt awful about our country's prospects when the other party was in office. So if we had used the blue line in the top chart, the K-shape would have been wider and things would have looked even more divergent. Conversely, using the red line in the top chart would have produced a narrower K-shape. In previous webinars, we shared how political divisiveness across the parties, politicians, and constituents has consistently worsened since the 1960s. But it's interesting to note that sentiment across both groups of consumers has been more volatile and downward trending in recent years. Okay, so a company's profits are essentially shared between its employees, also referred to as labor, and its shareholders, also referred to as capital owners. As you can see from the top chart on slide 6, over 3-year periods from the 1950s to the 2000s, employees' share of corporate profits was 56%, while shareholders' share was 8%. And since then, respective shares have widened, with employees now down to 52% and shareholders up to 12%. So that's a shift of about 4%. And that might not seem like a lot, but it's roughly $1.2 trillion away from employees and to shareholders on a run rate basis every year. And that transfer creates our second K of the day. The change is likely related to several factors, including less unionization and lower corporate taxes, as well as globalization, automation, and all of those benefit shareholders more than they do employees. However, it could worsen, that divergence could worsen as we continue to make advances in AI and robotics. Now, the bottom chart illustrates a future K we see coming for consumer spending. We've separated the data based on income for the top 10% of earners, represented by the orange line, and the bottom 90% represented by the blue line. In 1990, the top 10% represented approximately 40% of consumer spending. Today, they represent about 49%. Over the same period, the bottom 90% decreased from approximately 60% to about 51%. So the top 10% of us are spending about $10 trillion per year, while the remaining 9 out of 10 of us are spending approximately $11 trillion per year. And we wouldn't be surprised if these lines, the dashed lines on your screen, cross in the future, possibly in 26, and therefore creating yet another K. As I'm sure you can all appreciate, consumer spending on the previous chart is oftentimes supported by consumer credit. That's especially true for the bottom 90% group we just showed. The top chart on slide 7 displays consumer credit that is considered severely delinquent, meaning more than 90 days past due. Starting with the prime rated borrowers or those with FICO scores of at least 620, you cannot even see the 4 lines for mortgage, autos, credit cards, and student loans. But trust me, they're there. And that means that the prime borrowers, representing approximately 75% of American adults, or 195 million people, have never become seriously delinquent with their credit, or at least if they became delinquent, they were first having their credit scores lowered before they became delinquent. However, the story is completely different for subprime borrowers, which are the remaining 25% of American adults, or 62 million people. As you can see, each of the 4 subprime lines is higher or more delinquent today than it has been historically. That's true for mortgages in the light blue line, aside from the lump related to the global financial crisis, as well as the other 3 lines that you can see. So just let your eyes go back in time and you'll see how they're higher today than they were historically. Notably, student loan borrowers were given a 5-year reprieve following COVID, which has recently lapsed. That this chart highlights the point that the most vulnerable among us seem to be becoming even more vulnerable. The bottom chart shows that we may soon be redefining what we mean by vulnerable. And that's because in the past, it may have been easy to dismiss those who were being left behind as lacking education or motivation, perhaps like those with low FICO scores in the top chart. Just easy to dismiss that cohort of people. However, in the future, those people lacking skills, practical skills that cannot be automated away by AI and or robotics, could themselves become vulnerable. This chart plots job cuts that were announced on a quarterly basis. As you can see, aside from COVID in 2020, announced layoffs were relatively stable, around 500,000 workers per year. However, in 23 and 2024, announcements began to tick upward, and in 2025, they jumped to approximately 1.2 million workers. The groups hardest hit include recent college grads, office workers, and government employees. We suspect these announcements will continue rising as companies continue to embrace AI and robotics in an effort to become more efficient, more effective, competitive, and profitable by automating away tasks that are currently done by humans. To emphasize, our key takeaway is we wouldn't be surprised to see the unemployment rate for higher educated but less experienced people exceed that of skilled people, those with skilled trades in the future. And we question whether that could create another future case, since it would be the first time in our country's history that skilled workers were more employable than college grads. All right, with that, let me turn it over to Marc to dive more into the advances in AI and what we're seeing there as things are continuing to progress.
Thanks, John. I'll begin our discussion on AI with the review of recent advancements against selected performance benchmarks. We shared this same chart in our webinar of January of last year. Recall that the dashed gray line in the chart on slide 8 is the human baseline, with any performance above that horizontal line representing advances in AI that exceed human capabilities, and any performance below that line representing advances that have not yet achieved human capabilities. So, for example, starting in 2012, AI advances, including image classification, that's the black line, followed many years of slow but continuous progress in pattern recognition. As you can see, AI image classification started at about 89% of human-level capabilities in 2012, achieving human-level capabilities a few years later in 2015, and somewhat exceeding humans since then. As you move from left to right, the time to achieve human-level capabilities has compressed, with the slope of each line getting steeper and steeper, indicating rapid progress to achieving or even surpassing human-level achievement. In the interest of time, let's isolate a couple of lines at the far right of the chart to highlight some of the remarkable progress in AI over the past few years. The orange line, unlike in last year's presentation, shows AI systems reaching and now surpassing human-level proficiency in competitive math. In 2021, AI systems were only correctly answering about 6 to 7% of competition-level math questions and failed to consistently grasp basic relationships. And now today, the accuracy of AI-based math programs score at 109% of the baseline or better than human-level capability. AI reaches similar proficiency in PhD-level science questions, the peach line on the far right. When those tests were initiated in 2023, AI systems were less than 50% of the human baseline. Last, the gold line at the end of the chart shows development against multimodal understanding and reasoning tests. This benchmark assesses AI systems on complex tasks that require interpretation and reasoning across diverse data types, such as text, images, video, and audio, in fields like science, art and design, business, health and medicine, and tech and engineering. In less than 2 years, AI systems are closely approaching human-level performance on these more complicated tests. Overall, AI progress has been rapid and will continue to be so. But going from test taking to autonomous work and real-world reasoning will require more training and years of additional development. Now, during a talk at the Center for Strategic and International Studies last month, NVIDIA CEO Jensen Huang described AI as a 5-layer cake, requiring proficiencies across multiple stacks of the economy, rather than just in the isolated pieces of software and hardware. And to achieve AI leadership at scale, it is necessary for a country to align and build out the entire stack and not just master a single slice of it. As part of his presentation, Jensen compared the 2 leaders in the AI race, the US and China, against this multifaceted framework. The base layer is energy, and before you can have intelligence, you need electricity. In this regard, China has twice the installed energy capacity of the US and is growing its capacity at a rate that is 2 times that of the US. The next layer is chips or semiconductors to perform the core computations underlying AI models. Here, the US is a few generations ahead of China, but the Chinese excel at electronic manufacturing and are committing considerable funds to develop their own native chip supply chain. The middle layer is infrastructure, and specifically physical data centers, networks, and cooling systems required to scale computing. The US has installed data center capacities of about 54 gigawatts versus 32 gigawatts in China. Nonetheless, Jensen highlighted a massive velocity gap in the US with regard to infrastructure, as it takes roughly 3 years to build a new data center in the US versus just 3 months in China. So the current US edge in infrastructure could quickly flip. The next layer is the models and algorithms trained on the infrastructure. The US leads in proprietary models with about a 6-month lead on the open source models that power Chinese AI models and the vast majority of global AI development. The final or top layer are the applications like chatbots that users interact with. Jensen's personal opinion is that a large majority of the Chinese view AI as a net positive, suggestive of broad openness to AI services and adapting institutions to meet the changes that come with these new tools. Whereas he sees Americans as having a much more cautious perspective on AI that may frustrate wide acceptance or our ability to manage the potential dislocations that come from it. To achieve leadership in artificial intelligence, the largest hyperscalers that own and operate data centers, or the middle layer in Jensen's cake, they've had to commit tens of billions and collectively hundreds of billions of dollars on capital expenditures to acquire leading-edge GPUs and invest in energy and other infrastructure assets. These spending plans have grown tremendously over the past 5 years, with continued growth forecasted into 2028. As you can see in the top chart of slide 10, these 5 hyperscalers, that's Alphabet, Amazon, Meta, Microsoft, and Oracle, in total funded roughly $100 billion in CapEx in 2020, the blue line to the far left of the chart. The figures move up in each progressive year with a dramatic acceleration following the release of ChatGPT in late 2022. Aggregate capital expenditures for these companies for 2025 are estimated to be slightly less than $370 billion and rise to more than $600 billion by 2028. At current levels, the annual spend of $370 billion is akin to acquiring Netflix for all cash and doing so every year and with money to spare in the coming years. Now, the ramp up of CapEx around AI infrastructure has been staggering, but so too has been the losses borne by leading AI model developers. The bottom chart on slide 10 shows the cumulative losses by various startups prior to achieving profitability. For reference, we show that Amazon accumulated $3 billion in losses before turning profitable at the end of 2001. Similar figures for Spotify, Tesla, and Uber were 6, 7, and 32 billion, respectively. Since its founding in 2021, Anthropic has incurred billion-dollar losses, but expects to break even in 2028 and record cumulative losses of around $15 billion. That's at a level at the higher end of the comparisons to the left, but terribly irregular. OpenAI, on the other hand, does not expect to earn a profit anytime soon, with estimates of losses that will accrue to around $145 billion by 2029. Unlike Anthropic, OpenAI has made substantial lease commitments to have exclusive access to planned data centers in the years ahead, with cash flow and profit objectives clearly being subordinated to its larger goal of attaining artificial general intelligence and being the dominant AI factory. The CapEx spend on AI infrastructure and the near-term losses for AI model developers look astounding, but in relation to other critical investments of the past, they look fairly normal. The top chart on slide 11 examines peak annual investment as a percent of US GDP for a handful of these transformative projects. The peak annual spend for all these examples ranges from about 1 to 5% of US GDP. As you can see on the far right, hyperscaler CapEx, whether it's based on the 2025 levels in the orange or higher projected levels in the next couple of years in the yellow, is similar to the annual spend on rural electrification in the 30s and 40s, getting to the man on the moon in the 1960s, the development of the interstate highway system in the 50s and 60s, and the rollout of broadband internet services in the early 2000s. With deregulation and more rapid obsolescence of newer technologies in recent years, funding for these large societal investments has shifted more to the private sector, and as such, the benefits are less uniformly shared across the economy. Along those lines, the bottom chart on slide 11 illustrates the disproportionate gains from AI accruing to a small subset of companies. The chart displays the change in market cap for the S&P 500, segmented by 41 related AI companies, including the Mag 7, and the other 459 companies since the launch of ChatGPT in late 2022. The total change in the S&P 500 market cap over that time horizon was just north of $26 trillion, with the AI-related companies in the orange accounting for 18 trillion or 69% of that total, and the rest of the index in the blue representing a bit more than $8 trillion or 31% of the increase. On a per company average, the 41 related companies rose by about $440 billion, more than 25 times the average for the rest of the companies in the S&P 500 during this period. With that, I'll turn it back to John to talk about budgets, barrels, and borders.
Okay, thanks, Mark. The next couple of slides share insights into challenges we're going to have to solve as the economy, or as an economy and as a society. Our national deficit is running hot, but is at least expected to stabilize over the next 5 years. As you trace the black deficit line backward, you can see that the only time our deficit has been this negative was during COVID around 2020 and the GFC around 2008 and World War II from the late 1930s to the early 1940s. As we've discussed in prior webinars, durably running deficits around 5.5% simply isn't sustainable. Doing so for too long could lead to rising inflation, slower growth, and falling US dollar. Some estimates suggest that the US could manage through deficits of 3%, but from current levels, that would mean either increasing our federal revenue or cutting our federal outlays by $775 billion per year, with few options to do so. The top chart shows that payroll taxes in the green and individual taxes in the blue make up the bulk of our federal revenue. But as we just discussed, unemployment could worsen in the years ahead as AI and robotics put the squeeze on jobs, payrolls, and income tax. If those inflows do indeed decrease, we'd have little choice but to increase corporate taxes in the yellow. Otherwise, our national deficit would balloon. And naturally, if and as corporate taxes increase, we'd expect to see stock prices decrease as less after-tax cash flow would accrue to shareholders. Now, there are different ways to tax companies, some of which are broad-based, like simply increasing tax rates on all companies, but taxes can also target certain companies, like hyperscalers and related AI companies, by requiring, for example, that they pay for the energy costs of their data centers. Last week, the Trump administration began laying out a framework for PJM, the country's largest utility operator, to begin charging via electricity auctions the hyperscalers for the electricity they plan to use. The bottom chart plots the same data as the top chart, but here we highlight the large components of federal outlays. From our lens, there's not much spending that would likely be politically survivable for lawmakers to cut from our federal budget. Social Security and Medicare and Medicaid account for 51% of our current outlays and are expected to grow both in dollar terms and as a percentage of GDP, at least through 2030. So those components are already squeezing out other spending. Net interest is essentially paying ourselves back for the $38 trillion in national debt we've already racked up, representing about 120% of our GDP. And many believe that our national defense should increase going forward as the risk of military conflicts around the world grows. So that leaves only discretionary spending of about 4.6%, but much of that tends to be locked in over periods of years, making any cuts less impactful than one might hope. Moreover, those cuts might lead to defunding projects and therefore people who would otherwise be employed taxpayers. We'd be remiss if we didn't mention a key takeaway related to our budget. As we previously mentioned, the Social Security Trust Fund is expected to be depleted in approximately 2033, with the benefits reduced by roughly 80% of their current payout levels. There are 74 million retirees receiving Social Security benefits today, which is expected to reach 80 million by the time the trust fund is depleted. If you're wondering about what kind of political upheaval we could face, just wait until the payments to 80 million American retirees are slashed by 20%. So we find ourselves with difficult choices, and the decisions that we make will have varying implications for governance, companies, and individuals. We've obviously been seeing some shift in our foreign policy, especially with Venezuela and Greenland. Shifts of this magnitude cause us to ask ourselves, what will other countries do? How will they react? Time will tell, and we'll be monitoring any developments closely. But from the highest level, we see this as the US, or at least the Trump administration, using its power and influence to shore up protection and resources. I won't go through all the bullets here, but the primary reasons for the action in Venezuela appear twofold. First, the US plans to develop the country's world-leading reserves of heavy sour crude, which is precisely the type of oil that's used by our US Gulf refineries. And second, to curtail the constant flow of drugs, specifically cocaine, into the United States. Likewise, there seem to be two primary reasons for the Trump administration to annex, or the desire to annex, Greenland. First, the country's location, which could become a gateway to trade with China as the Arctic ice cap continues to melt, would support the US's development of a Golden Dome missile defense system, and that would be similar in concept and design to Israel's Iron Dome system. And second, the country is believed to contain significant natural resources, including rare earths, uranium, and other minerals, as well as possibly meaningful reserves of oil and natural gas. The U.S. has mentioned four options, including persuasion, purchase, tariffs, and military force, to move forward with Greenland. But earlier this week, the Trump administration walked back the latter two during his trip to Davos. As for a purchase option, the country's known resource reserves are valued at about $200 billion. And the purchase value of the country is estimated at approximately $700 billion. Importantly, Denmark has been giving the country $700 million a year in transfers or aids or payments in order to keep the economy afloat. Denmark's GDP is only about $425 billion a year, or about 1.5% that of the US. So it's somewhat curious why the Danish people support that amount of spending going to Greenland every year. And Greenland's GDP is only about $3.5 billion a year, or 1/1000th of the US's GDP. And its GDP has been flat to declining for years. Moreover, we imagine that some of its citizens, especially the 38,000 living and working in small, impoverished, and isolated fishing villages, wouldn't mind converting their natural resources into an economic fund, much like the citizens of Alaska have done with its Alaska Permanent Fund. That permanent fund, which was based on oil revenues and reserves, currently has about $80 billion in assets under management. And it is expected to pay a permanent fund dividend this year, or PFD, of roughly $4,500 for each of its eligible citizens in Alaska in 2026. And that includes the children and the adults. So we would certainly understand if both the Danish and Greenlanders eventually want to make a deal with the US. There's been press in recent days about coming together on a deal, but we'll keep you posted as we learn more. All right, let me turn that over to Marc now to share our concluding remarks.
Thanks, John. I'll close with slide 14 and reinforce several points that we've communicated in recent webinars. Specifically, the US economy and financial markets remain resilient, but gains to consumers and investors have been unevenly distributed, and shifting geopolitics and technological innovation are creating some new risks as well as opportunities. Strong US economic growth in 2025 should spill into 2026, especially in the first half of the year as the tax and spending impacts of the One Big Beautiful Bill Act become more visible. Higher income households continue to drive spending gains due to higher real wage growth and the wealth effect from ascendant financial markets. On the other hand, lower income households continue to struggle with affordability, higher defaults, and stretched budgets. The labor market has settled into a low hire, low fire equilibrium. US non-farm payrolls were up roughly 600,000 over the last year, but down from about 2 million additions in 2024. Notably, 80% of the jobs created in 2025 were in the first half of the year, and those jobs largely concentrated in the healthcare and social assistance sectors. While unemployment remains low at 4.4%, the average length of unemployment at 24.4 weeks is the highest since 1948, excluding the months around the global financial crisis and COVID. Geopolitics present some new risks with tensions or conflicts around the world and fraying relationships among allies in the West. At the same time, the strategic imperative to develop AI and control the necessary resources around it has intensified competition between the US and China and has also catalyzed new investment opportunities. Against this backdrop, investors remain heavily concentrated in US assets and within US equity markets, the Mag 7. Over the course of 2025, performance within the Mag 7 has become more dispersed, and more recently, the overall market has broadened out with value stocks, small caps, and foreign markets outpacing the S&P 500. As we turn to 2026, this environment is precisely when we think investors should embrace diversification and hold assets across different asset classes, sizes, styles, geographies, and underlying currencies, and be ready and able to thoughtfully reallocate across the portfolio should market drawdowns occur and new opportunities emerge. So with that, I'll turn it over to Jan and Laura for any questions.
Thanks, Marc. We received several great questions during the presentation. We touched on some of them already, but perhaps we can share some additional insights. As a reminder, if you'd like to submit a question, please use the Q&A box on your screen. Let's start with the following. Are we in an AI bubble?
You want to start, Marc? Are we in an AI bubble?
Yeah, listen, I think we still have a long way to go in terms of the development of AI. So some would argue the bubble is ahead of us, not that we're currently in it. Having said that, you are seeing some companies trade at pretty remarkable multiples, especially in the private markets, companies being valued near 30 times revenue, which is quite severe. Having said that, though, like those companies are growing at levels that we've not seen very much in history. So growth is supporting valuations for the time being. I think we have to assess, how much of this spending is durable. So that's one aspect of it. If you look at the AI leaders in the US, it's kind of the handful, the Mag 7 with some private companies like OpenAI, Anthropic, even Grok. And then you have the Chinese leaders, Baidu, Tencent, and Alibaba, and some private players there. So you have about 10 or 12 large companies competing for leadership in AI. And it's hard to see over the course of the next 5-10 years that all those companies are going to get to the other side and be leaders in AI. So you're probably going to have one or two or more of these large companies have their valuation suffer as AI develops. But I think there's other ways to play AI that we think are are a little bit safer than trying to pick a winner as this race unfolds over the next 5 or 10 years.
Yeah, I don't have much more to add. We are sort of on the lookout for some big IPOs that could occur later this year with OpenAI, possibly ChatGPT, and SpaceX. So you're still seeing the winners or the leaders be heavily rewarded, but at the same time, as Mark was going through some of the data, you see OpenAI incurring massive losses to the tune that we haven't seen from prior startups. So if that's a representation of some portion of the 41 companies that we identified in the AI sphere, you could have a lot of those companies face challenges, if not need to be merged, acquired, or simply go out of business, while others will win. So are we in an AI bubble? As Mark said, probably as a category, the future of a bubble is still in front of us. But individually, you can imagine that some companies will start to fail, maybe in the not too distant future.
And just as I mentioned, other ways to play AI. I think one way that we've been talking about, but it had nothing to do with AI, is just owning high quality companies, barriers around their business, competitive moats that have pricing power. So you're going to want those businesses as AI comes more widely adopted and you're seeing disruption to business models. Those businesses should withstand that better. We talked about infrastructure in our AI session today. So owning utilities and things that are at the base layer of the whole AI theme is another way to play this. There's going to be a lot of good use cases for AI, but there's also going to be a lot of bad use cases for it. So there's going to be more cyber attacks and things like that. So investing around cybersecurity is another way to play it. And then finally, I also think biotech is an interesting way to play AI. We've already seen kind of alpha or protein folding, Google releasing 200 million 3D dimensions of the amino acid chains and proteins that should speed up and make new innovation in biotech much cheaper and more targeted. So those are a couple other ways to play AI versus, backing who we think is going to be a leader once you get to AGI in the next, several years.
Just to stay on the AI topic, what about the gap in, can you talk a little bit more about the gap in the AI capabilities between US and China?
Yeah, I think right now the US has the advantage in chips and models. I would say, given all the effort that China is putting behind this and just how they've scaled their supply chain over the last 20 years, and the fact that they do have an advantage in power, I think this is a race that's going to be pretty close, even though the US probably currently has a bit of an edge. I wouldn't suggest by any stretch that the US is going to maintain that. We got a lot of work to do. We got to figure out how we can generate more power, which has a whole bunch of challenges from construction to transmission lines, etc. So right now we're up, but it's going to be a close race over the course of the next 5 to 10 years.
Yeah, just one thing I'd add is Mark talked about Jensen Huang's 5-layered cake and the top layer being application. So to me, that's the crux of it. It's the mindset with which you're approaching AI. So in China, Jensen's perspective is that 80% or so of Chinese believe that AI will do more good than harm. And it's the opposite in the United States, that 80% would say that it will do more harm than good. That's his perspective, but he's obviously got a courtside seat to the developments going on around AI. So when you think about that, and in a control and command economy like China, with 80% of your population behind it, you have the ability with the transitions that will need to occur with our institutions, with political issues, with redistribution. You have the sort of focus and the support to do so. In the United States, geez, we haven't even figured out how to tax the hyperscalers yet. I mentioned, energy and putting energy out for auction, but we've allowed them to benefit for many decades, really, over automation and displacing workers, and now just accelerating that advancement. It's the concern that a lot of Americans have about losing their jobs, and rightfully so, rather than leaning into it and embracing it. And frankly, if it takes 3 years in the US to build a data center and 3 months in China to build one, how long will it take to get the policy decisions right around AI in order for us to go from 20% of Americans supporting AI to 80% of Americans supporting AI? So to me, the top layer of the cake, the applications, the real world things that touch us and touch businesses, that's going to be where we win or lose. And we'll do that if we have the mindset and the will to do it as an economy and as a society.
Thanks. The next question is, we often frame emerging markets as a way to diversify away from tech-heavy US equities, but it seems like emerging markets are very AI-heavy or hyperscaler linked themselves, like Taiwan or South Korea. What should we make of this?
So look, there's no doubt that Taiwan is the leader in chips. We've been fortunate that TSMC has now been investing heavily in the state of Arizona and building out, a very large data center. I think it was something like they had acquired 1,100 acres of land last year during Trump's tariff negotiations, and just earlier this year, another 900 acres of land. So they're planning on building quite a large chip manufacturing and possibly spinning off of that some data center capabilities as well. When it comes to the chips, though, that they're bringing here, those are likely to be their second-tier chips and leaving their best chips behind in Taiwan for manufacturing. But the yield, importantly, the yield that they're getting from the chips that they are manufacturing in the US has been quite good. I use that as an example to talk about emerging markets. If you're going to talk about Taiwan or you're going to talk about China, understand that we're invested in those countries and in those companies through our portfolio allocations. We've used valuation as our lens or our compass to decide how much to be allocated in those countries. We have had at least a benchmark weighting, in some years a higher than benchmark weighting, because the valuations have been lower. Certainly, like in the US, some of those countries will win, some of them will lose. Some of the companies within those countries will win or lose. But there is cross-pollination of businesses, whether the TSMC example that I gave or plenty of others. For example, China, or a Chinese company, owns 80% of Boston Dynamics, one of the leading robotics companies in the United States. So there's cross-ownership and there's cross-investment and development going on. We believe that having diversification is important because we can't tell you today which of those businesses or countries are going to win or lose. We feel very good about the US maintaining its edge in terms of strength and resiliency, but one or a series of bad decisions or missteps, and we could lose some of that, as Marc was talking about, with the layers of the cake. So we are invested in EM. We also like the currency diversification that we get in when we sit in our US seats with a US dollar that is going through some of those debt issues and debt mitigation or remediation or payment issues that I was talking about earlier. It does concern us a little bit about the strength and sustainability of the US dollar.
But getting back to EM and AI, that's another way to play the AI theme. Within Taiwan, obviously chips, within South Korea, memory chips and batteries, and then in China, kind of AI model developers. So there are aspects of that exposure that will give you AI thematic exposure as well, if that is something that you're also interested in.
What are your thoughts on investments in the US defense industry?
Oh my gosh. Look, national defense has always been an important part of any country's sovereignty. As you may have noticed from one of the charts that I had shown with the federal budget, the revenues were at the top, the federal revenues were at the top, the outlays were at the bottom. National defense was a much, much larger portion of our national budget as a percentage of GDP going through the pre-war years, the post-war years, and all the way up through the Cold War in the 1980s. Since then, it's become a significantly lesser component of what we've been doing in terms of the national budget. So obviously, the US government is the ultimate purchaser of any products, goods, or services that come from defense. So you have to have that in your mind. Is the national defense budget going to increase or decrease? That has to be in your mind before you start to take a specific view about defense. But we have been really pretty excited about some of the defense companies like Anduril, for example, that's using AI in order to power and develop planes that are autonomous, that can seek out targets and attack targets without ever putting a pilot in the cockpit, along with a whole host of other products that Anduril and its competitors offer. So defense is an interesting space to be in. We think that we certainly own some exposure to defense in our portfolios. Marc was sort of talking about potentially casting with a line, so maybe private investing and looking for different opportunities that can be thematic in nature or more strategic to a portfolio. So we'd encourage clients to reach out to their CSTs to discuss with us on a one-on-one conversation how they might approach adding additional defense or defense exposure in their portfolios.
Yeah, just to quickly add, we've been looking into that area for the last couple of years, more on the private side, and it hasn't been much outside of the major or prime defense contractors up until like the last 5 or 10 years even. So you don't have a lot of managers with a ton of history, so that's a bit of a limiting factor, but it's an area that we think is interesting just from kind of a secular shift. As the world is a more dangerous place today than it was for much of the last 75 years. That's probably more the anomaly. Just that peaceful period post World War II, we're in a world where there's just more tension and likely to be that way. So there'll be more spending on defense, and then just the retrenchment from U.S. in terms of providing that security umbrella around the world. You're seeing Europe and other areas commit more funds to that. So it's an interesting space that we'll continue to look into.
In today's environment, what are some other ways to diversify portfolios with uncorrelated assets that are still expected to earn a reasonable return?
We've talked about, as a category, so let me back up. So for our strategic portfolios, those are the family of portfolios that we manage that tend to be more benchmark sensitive. We tend to just own long-only equities and long-only bonds because that's what our benchmarks own. So that's a family of portfolios that we offer to clients, for clients that are wanting to make sure that they are fully invested and that their portfolios are behaving somewhat similarly in all environments to their passive benchmarks. The other family of portfolios that we offer are dynamic portfolios. And within the dynamic portfolios, we do offer a category of investments called diversifiers. And those diversifiers tend to be ways to have exposure that is lower correlation or even negative correlation in some regards to your long-only equities and bonds. And because of that, the addition of that into the dynamic portfolios creates a more stable return pattern. That's really suited for clients that are willing to give up some upside return when the markets are rallying, but they want the comfort of downside protection. So our dynamic portfolios going through Q1 of last year and coming out of Q2, for example, were significantly more stable than our strategic portfolios. Okay, so I wanted to set that stage first. Within diversifiers, then, for the dynamic portfolios, we have exposure to different kinds of arbitrage strategies, so convertible arbitrage, merger arbitrage, and so on. Those are low correlation with equities or bonds. They tend to just earn a risk-free rate of return, so a treasury return plus a spread. We have gold and other commodities that we hold within that kind of a portfolio. We take long-short perspectives on portfolios, so we'll be long some equities and short other equities, or we'll be long some commodities and short other commodities within that portfolio. So really looking for opportunities, even in some corners of the market, to do things that have really unique characteristics within client portfolios. In some years, like 2020, 2022, 2025 last year, and so far this year, that part of our client portfolios has really been performing extremely well. And in the environment that we just went through, both Marc's comments and my comments, in a world that's very uncertain and has a lot of shifting big levers to it, we think that a wise decision for those that want to have comfort is to own diversifiers through our strategic portfolios. Marc, you want to add to that? I think we're going to get close to wrapping up as well.
Have you observed any impact on portfolios from the recent tariffs?
I think the tariffs were originally expected to bring in like $800 billion or something like that a year. More recently, that has been cut back to $400 to $450 billion, and I think what we've actually collected is more like $200 or $300 billion. So in a budget like the one that we were talking about a few moments ago on one of the slides that I went through, it's a significant amount of money, but it's not a game changer in terms of the issues that we're facing. So from an inflow into the economy, it's not as demonstrative as you might think, number one. Number two, we've seen some recent studies that probably unsurprising to some, probably surprising to others. You know, it's really ultimately U.S. companies and U.S. consumers that are paying those tariffs. So on the one hand, you might see an inflow or a protection in terms of revenues. On the other hand, you might see some pricing pressure from companies that can pass along the impact of the tariffs to consumers. But what we've seen is from recent studies is that U.S. companies and citizens are actually paying more of that. So in terms of the impact on portfolios, it's been negligible. Within the companies that we really focus on, lower valued companies, high quality companies, smaller cap companies, the impact has been trivial in terms of the actual impact on portfolios. It probably is more important in terms of the negotiating power that the U.S. has had for other things that it's been trying to get done, including, for example, Venezuela and Greenland that I was mentioning a few moments ago.
Yeah, I think the tariffs had some of an impact in the first quarter of last year where people were front loading imports, so it impacted growth. But beyond that, growth has held up pretty well. Within inflation, if you look at the inflation file, 20% of CPI comes from goods. Within goods, you're only really seeing it in home furnishings and other durables. And inflation's generally been stuck. It's come down slightly, but again, we're not seeing a ton of inflation from tariffs there. To John's point, I think where tariffs might have more of an impact is just how the rest of the world views the U.S. because they've been weaponized in some ways. And does that make people as comfortable investing in the U.S., given that they're already highly concentrated in the U.S.? What does that mean going forward? We saw some dollar weakness last year. I think that's probably an area worth monitoring.
Well, thank you. It looks like we've reached the end of our webinar. We truly appreciate your participation and thank you for sharing your questions and thoughts with us. If we didn't get to your question today, no worries. Your client service team will be following up with you in the coming days. As we wrap up, we recognize that ongoing policy uncertainty, geopolitical tensions, mixed headlines, and market uncertainty can feel uneasy. But at the same time, we remain optimistic and agile, positioning portfolios to capture opportunities ahead by focusing on long-term trends, innovation, and thoughtful diversification. We hope today's discussion has strengthened your confidence in the research we do and the insights we use to manage your portfolios thoughtfully and in a balanced way. We truly appreciate your trust and partnership as we navigate an ever-changing global economic and political landscape together. We look forward to welcoming you to our upcoming webinars. Beginning in April, we'll feature a new and improved format, and we are very excited to share it with you. Please remember that your client service team is always available to discuss any thoughts that you have about the markets or your portfolio. Never hesitate to reach out. Thank you again for joining us today. Have a great day. Take care. And to those impacted by snow and cold over the next few days, please stay safe and warm.
Thanks, everybody.